Ticker symbol. A ticker symbol is a unique short combination of letters and/or numbers that represents a publicly traded company on a stock exchange. It's used to quickly identify and track a company's stock during trading. The name came from the distinctive ticking sound the ticker tape machine made when transmitting stock prices and symbols over telegraph lines and printing them onto ticker tape. Initial public offering. Imagine a super popular private donut shop called Donut Co. For years, it's only been owned by the original founders and a few close friends. But now they have a big dream. They want to open hundreds of new shops all over the country, but that's going to cost a lot of dough. So they fill out the paperwork for an initial public offering, or IPO. An IPO is basically the first time a private company like Donut Co. lets the general public buy a piece of their business. By selling these small pieces or shares, Donut Co. is able to raise money for expansion plans, hiring more employees, launching new products, and allows the original owners to finally cash out some of their hard-earned investment, as they can sell a portion of their shares to the public. Market capitalization. Now that Donut Co. is a publicly traded company, investors would like to know how big the company really is. To figure that out, they calculate the market capitalization, or market cap for short, by taking the current price of one share and multiplying it by the total number of shares. So if the stock price of Donut Co. is $20 per share and there are 1 million outstanding shares, then market cap of Donut Co. is $20 million. Larger market caps, companies greater than $200 billion, generally represent more established, stable companies. Smaller market caps, companies less than $300 million, indicate higher risk but also greater growth. Dividend yield. It's now been 30 years since Donut Co. became a publicly traded company. The capital it raised has allowed the company to expand nationwide and roll out popular new donut flavors, leading to consecutive years of record-breaking profits. To reward shareholders, Donut Co. decides to distribute part of its earnings to the shareholders. This payment is called a dividend. Suppose Donut Co. pays a $1 annual dividend per share and its stock is currently trading at $20 per share. You can calculate the dividend yield by dividing the annual dividend by the stock price. In this case, Donut Co. offers a 5% dividend yield. So if an investor owns 100 shares, they'll receive an annual payout of $100. A high dividend yield can seem super appealing. However, you have to be careful. A high dividend yield isn't always a good thing. Sometimes a company's stock price drops, and that can make the dividend yield look artificially high. For example, if the price of that Donut Co. stock suddenly fell to $10 a share, but they were still paying that $1 annual dividend, the dividend yield would jump to 10%. While that looks great on paper, it could mean the company isn't financially healthy and that the stock price is falling. Blue chip stocks. Blue chip stocks are the shares of large, well-established, and financially sound companies with a long history of reliable performance. They are considered safe investments because these companies often have a strong reputation and are able to operate profitably even during economic downturns. Net profit margin. Net profit margin shows how much actual profit a company makes from every dollar of sales after deducting all expenses, including operating costs, interest, and taxes. It is calculated by dividing the net profit by the total revenue and multiplying by 100. For example, if Donut Co. sells a donut for $1, but after covering ingredients, wages, rent, taxes, and other expenses, they keep 10 cents as profit. That means their net profit margin is 10%. A higher net profit margin generally indicates a more efficient and financially healthy business. However, what counts as healthy depends heavily on the industry. Software companies often have very high margins, while sectors like retail or auto repair operate with much slimmer margins due to higher costs. Debt to equity. Let's say Donut Co. wants to expand into the soft drink industry. To get the money they need, they have two main options. They could get a loan from a bank, acquiring debt, or use money from their savings or from investors who buy a share of the business. Use their equity. If Donut Co. took out $20,000 in bank loans, debt, and used $100,000 from investors, equity, their DE ratio would be 0.2. The debt-to-equity ratio is a simple comparison of these two sources of funding. A high ratio means a company is using a lot of borrowed money to grow. A low ratio means it's relying more on its own resources and is less leveraged. Return on equity. Return on equity, or ROE, is used to see how well a company is using its investors' money. Suppose Donut Co. has collected $100,000 from its shareholders. This is the company's equity. At the end of the year, Donut Co. makes a profit of $20,000. To figure out the ROE, you just compare the profit to the money that was invested. In this case, Donut Co. ROE is 20%, which means that for every dollar invested, the company generated 20 cents in profit. ROE is a great way to judge how well a company's management is doing. A high ROE means the company is really good at taking the money that investors have put in and turning it into more money. It's a sign of an efficient and profitable business. On the other hand, a low ROE could suggest that the company isn't using its shareholders' money effectively. Price-to-earnings ratio. A new shop, Donut Inc., is selling its stock for $10 a share. Last year, each share of the company's stock earned a profit of $1. That means for every dollar of profit, you're paying $10. In this case, the PE ratio is 10. This PE ratio is considered on the lower end. However, Donut Co.'s stock price is now $50, and each share earned a profit of $1 last year. The PE ratio is 50. This PE ratio is considered on the higher end. The PE ratio is a quick snapshot of market sentiment. A low PE might suggest the stock is undervalued or a good deal, but it could also mean the company has a problem. A high PE might mean the stock is overvalued, but it could also signal that investors expect the company to grow a lot in the future. PE ratios are usually compared for companies in the same industry. A PE of 20 might be great for one industry, but terrible for another. Trailing PE provides an objective view of historical performance, but doesn't account for future growth. Whereas forward PE reflects market expectations about a company's future growth, but relies on potentially inaccurate analyst estimates. Earnings per share. Suppose Donut Co. makes a total profit of $100,000 in a year. The company has 10,000 shares of stock issued to investors. To figure out the Donut Co.'s EPS, you divide the company's total profit by all of its outstanding shares. So the EPS for Donut Co. would be $10. This means that for every share of stock you own, the company made $10 in profit. EPS is a crucial indicator of a company's financial health and profitability. A higher EPS generally means the company is more profitable and is a better investment. It tells you how much value is being created for each share of stock. Liquidity. Liquidity describes an asset's ability to be quickly and easily converted into cash without a significant loss of value. It also refers to a company's financial strength and ability to meet its short-term obligations. High liquidity is like the cash in Donut Co.'s register. If they need money right now to pay suppliers, they can take that cash out immediately without losing any value. In the stock market, a stock with high liquidity is like that cash. It's easy to buy or sell quickly without the price changing much. Low liquidity is like their oven. If they suddenly needed cash, they couldn't sell their oven right away. They'd have to find a buyer and might have to sell it at a lower price than it's really worth just to get the cash fast. In the stock market, a stock with low liquidity is hard to sell quickly without taking a loss. Average volume. Average volume is the typical number of shares traded for a specific stock over a set period. A stock with high average volume means there are tons of customers buying and selling. So if you want to buy or sell the stock, it's easy to do so quickly and at a fair price. In other words, the stock is easy to liquidate. A stock with low average volume means there are few sellers and buyers, so sellers might have to drop the price just to find a buyer, or buyers might have to pay a much higher price to find a seller. This stock is considered illiquid, which can make it riskier to trade. So, in a nutshell, average volume is a quick way to see how popular and active a stock is.